Hi, everybody. This is Samantha from the law offices of Samantha Wolfe, and I'm here for our next virtual seminar, which is actually a part two of a virtual seminar that previously we had posted on our YouTube channel. So this is our part two. So welcome. Thank you for joining us. At our office, we enjoy getting to meet with clients and talk about everything from business succession planning to estate planning to asset protection planning and estate administration. And part of our job is to make sure that we're getting information out to our clients so that they're up to date on things that might have changed in the law, things they need to do. So we thought it might be fun to do a two-part series on business succession planning or business planning for our clients. So to the extent you haven't checked out part one, I would go check out part one. In that part, we talked about how to properly set up a business, how to work and file through the Department of State and the annual filings that you might need to do. So if you haven't checked that out, go look at that on our YouTube video or on our website. And then come back and you can watch our part two. So I'm going to go ahead and launch into our part two. Okay. So it is Boss Moves, estate planning for the CEO in your family. This is part two. So many exciting things. We had to break it up into two parts. So today we're going to go over part two. So we want to talk today. Here's our agenda for the seminar. We want to talk about business succession planning. Like I said, in part one, we talked about how to set up a business. So now we want to talk about how do we transition it to the next generation. So we're going to talk about business succession planning. We're going to talk about why you might want to have a succession plan, how you can identify future leaders and successors. We're going to talk about ownership transfer methods, including family transfers, buy-sell agreements, buyouts, third-party sales. We're going to talk about my favorite part of business succession planning is tax implications. We're going to talk about estate and gift tax, capital gains and income tax, and some tax minimization strategies. We're going to go over common mistakes, and then we're going to answer some commonly asked questions. So a lot we have to do today dealing with business planning, which is why we broke it up into two parts. So thank you for joining us today. We really appreciate it. So let's start with the basic of what do we mean when we say a business succession plan? So this would just be a plan where you're proactively thinking through the transferring of ownership, maybe the transition of leadership of a country, when the key owner or stakeholder retires, if they become incapacitated, or upon their death. So it's just basically putting in place a plan for any of those events. And a good succession plan would actually address all of those events. So we try to cover, yes, retirement is really important, but so is if someone becomes incapacitated or upon their death. Now, the scope of a business succession plan is going to ensure operational continuity, preserving the business value, and it's going to protect the stakeholders' interest. And the timing is a question I get a lot. When should you start doing business succession planning? And ideally, you want to start years before you're actually going to want to transition the business. Ideally, if I could get clients, if they've been working in a business, if I get clients and they're thinking of retiring or they're thinking about planning for the second half of life, ideally, early 50s would be an ideal time to do this because you want to start it long enough before the actual event that you can have all the documents in place, you can have all the transition paperwork in place, and then you can effectuate a transfer. And it might need to be gradual. And so you want to make sure you have enough time to do all of those things. Why might you want to have a succession plan? So the biggest thing is the continuity and stability. If you've put all your time, money, and effort into creating this entity and this business and it's successful, then you want to prevent the chaos. If all of a sudden you're unavailable, or if some event happens where maybe you can't be as involved as you normally are, you want to make sure that you're allowing that business to flourish, even if you're not able to be there. It helps preserve the value, maintains the company's reputation, minimizes revenue loss. It can avoid conflicts, especially when we're talking about a family-owned business, because families have different ideas, different children have different ideas of what should happen. So if you can put a plan in place, clarifies roles and expectations among the different parties or family members. It can help with strategic growth because it allows the smooth transition, which really helps when you're talking about investors or other owners, customers, employees. It helps them know that this entity, this business is going to continue in the future. And then lastly, you have legacy and family considerations. We want to make sure it aligns business decisions with personal estate planning goals. So that's all of the reasons why you might want to have a succession plan. Now, how you identify future leaders and successors, it could be that, especially if it's a family business and you have children or some other family member that's actively involved, you may already know who the future leaders and successors are, but you're going to have to decide whether you're going to elevate someone internally or whether you're going to look at external candidates. So internal would be making sure you're grooming employees, giving them institutional knowledge, and making sure that transition works. External, you might be bringing in a fresh perspective from the outside where you might not have that internally. So I think it's identifying what skill sets, what strengths you currently have, and whether those strengths align with what's needed for a leader. You want to assess skills and competencies, so leadership qualities, technical abilities, the cultural fit. You may have someone that is really great technically, can do the work, but maybe isn't great at details or maybe isn't great at the management side of things. So again, it's just identifying everybody's strengths and weaknesses and being realistic about that and figuring out where can you shore up or strengthen the business. You want to make sure that you're considering training and mentorship. So if you have somebody who you're elevating from within and maybe they have potential, you want to make sure you're training them and getting them the information they need to be able to excel in that leadership role. And then the timeline for transition. You want to think through that individual and how long is it going to take for them to learn the information? Where are they going to be at in life at the time? And you want to think through whether it's going to be a gradual transition or whether you want it to be a more abrupt transfer of power. So again, it all depends on what your business structure is, what the individual wants, what you want. And so the first step is figuring out who those leaders and successors are going to be. Now let's talk about some different transfer methods. So each method offers unique advantages, tax implications, levels of control. So you have to figure out what's important to you. Is the tax the most important? Is it that the transition of control is the most important? And again, you could have several things that are important to you. That's just going to help us figure out the method that would be best to transition. So factors that you want to consider would be family dynamics, financial need, the time frame, and the organizational structure. The four common approaches that I see would be intra-family transfers, and that could be by gift or sale. We see buy-sell agreements. We see gradual buyouts using an installment sale, and then we do see some third-party sales. So these would all be different ways that you could approach the succession of the entity. So family transfers would be if it's going to someone that would be related to you in some capacity. A lot of times it might be children, could be siblings, grandchildren. A lot of times we see it going from like uncles to nephews sometimes too. So again, that would all be considered a family transfer. And the things you want to consider when you're doing a family transfer is what's the estate and gift tax implications, because what is it to me versus what it's to the person I'm giving it to, whether they're competent and ready for the transition, and what that does to the family dynamics. We want to make sure we're minimizing the conflict and allowing that transition to occur in the most harmonious way possible. So the advantages of family transfer is that it'll maintain the family legacy. It leverages the loyalty and maybe somebody who's more familiar with the structure because maybe they've grown up and worked in the entity. So it just allows them to get rewarded for all their sweat equity that they might have invested in the entity. And then the cons would be possible tensions if some family members are involved and others are not. It's always interesting the perception that maybe children or grandchildren have of to whether or not they should be allowed to be in the business or should have an ownership interest. And so everybody has different ideas of what role they should have. So you just want to make sure that if you're doing a family transfer, that you're doing it in a way that accomplishes what you want, but does it in a way that's not creating conflict for the new owner. Buy-sell agreements are a great way to do this, and it could be that it's through a family transfer, you're triggering a buy-sell. Could be that this is a third party. The buy-sell agreement is just the agreement that outlines how this transition occurs. And usually a buy-sell agreement will cover if someone retires, if someone dies, if there's an incapacity, or somebody would be disabled, someone would go into a nursing home. Those are all what we call triggering events. Somebody's fired would be another triggering event. And you might have a buy-sell agreement, and it can be actually set up in 3 different ways. It can be a cross purchase, which, for example, if my sister and I were in business together, it means that something happens to her, she retires, she leaves the business, she needs long-term care, she passes away. It's triggered when that event happens, and it's between the two of us. So I'm basically buying her share. That's a cross purchase. An entity purchase would be where the entity itself is buying back the shares. And then the third way would be a hybrid. Like the agreement might say, well, first we'll give the other shareholders or owners the options to buy out. If they don't exercise, then the entity would buy out. So you can have a configuration where you offer something first, and then if that doesn't happen, there's a backup. And you have to think about how you want to fund this. So sometimes this is funded through life insurance, and we partner with a life insurance agent or broker. Could be that it's financed through the owners. So for example, if I am buying out my sister's share, it might be that I have a period of years in which I can do that. So if she would pass away, I would be buying it from her estate or from her husband, and it might have the terms, like how long do I have to buy it? Is there interest? All of that good stuff. The benefit of having a buy-sell agreement, and I love buy-sell agreements, is that it ensures a smooth transfer. There's usually a clear valuation process. How are we determining what the shares or the ownership interest is worth? And it lays it all out. The cons would be it does require upfront planning. And if you're going to fund it with life insurance, you have the cost of the life insurance and the question of who's paying that. Is that the entity, or is that the different owners that are paying it? One thing I'll note is a cross purchase is best used when there aren't a lot of owners, because if you had, for example, 12 owners and there's cross purchasing, then it can get a little complicated in how you're funding that. And if it's life insurance, then you'd have to have life insurance policies on all the owners. So cross purchases work best if there are 2 to 3 owners. At least that's my experience. Now you can do it where you give the other owners the ability to purchase, but you just might not want it to be with life insurance, because again, then you have to have a policy on all the owners. I see a lot of times where there's a buy-sell agreement that says that the other owners can buy out, these are the terms, and then they have to finance it, or it has to be installment sales where there's a gradual transfer. All of that's possible. The other thing to know about a buy-sell agreement is it can be in the governing document. So in part 1, we talked about things like operating agreements, bylaws, partnership agreements. You can have buy-sell provisions in those governing documents, or you can do it as a separate document. I like buy-sell agreements as a separate document, because then if the provisions change or you amend the provisions, it doesn't affect the governing document that you may have already decided all the other terms of. So that's just my preference, but you can do it either way. You can do a gradual buyout. That would be another way to do it. And that's a little bit of what we talked about with the buy-sell agreement. You can do it using an installment sale where over a period of time, you're buying ownership. So it just allows the successors to acquire the business in stages over time. The seller may retain partial ownership or receive payments from company profits. The pros, gradual transition, so it's not something that's happening all of a sudden. It allows a gradual phase out of the owner. It does reduce the financial burden on the successors. Cons, the seller still has to be partially involved, which can lead to overlapping authority or confusion unless you're coordinating that well. The other thing too is when you're doing a gradual buyout, you want to think about the relationship between the parties. So I have two brothers that are in business together, and one brother is unmarried, the other is married. And so we had to talk through because the sister-in-law would have to be interacting with the brother. And it's not that she didn't get along with the brother, but the conversation was more like, I don't want to have to get paid gradually from my brother-in-law. I just want it to happen and then just to be able to be his sister-in-law and not have to be in this agreement. So in that case, she didn't want a gradual buyout. She wanted it to just be a one-time payment. So you want to talk to your clients about that and make sure they feel comfortable with it and make sure that everybody, all the different parties feel comfortable with the provisions. Third-party sales would be where the entire business is sold to an external buyer, might be a competitor, might be a private equity firm, it might be another investor, could be somebody who's purchasing the business to have a business, might not have any experience in it. So the key considerations there would be the business valuation must be accurate and there must be some basis for it. So that's usually where you're going to partner with the accountant or with an appraiser. Negotiation of purchase terms, earnouts, retained equity. The pros, potentially it's the highest immediate payout. It's a clear break from the departing owners. Cons would be there might be cultural fit issues. There might be staffing issues if the staff doesn't like the new owner or if there's changes in how the business is being run, might be business rebranding. And the owner has less control over the company's future direction. Now that matters if the owner cares. So if they're just like, I want to be done, walk away, all of that, then this might be the way to go. My favorite tax implications that we want to make sure we're considering. So estate and gift tax, capital gains and income tax. Another one here that's not bullet pointed, but kind of goes in all of these death taxes would be inheritance tax. And then we want to talk about tax minimization strategies. So the estate and gift tax, we have a little bit more clarity now that Trump passed the big, beautiful bill about what federal estate gift tax is going to look like in the future. So we know for the rest of 2025, we have a $13.9 million exemption and a $19,000 annual exclusion. But we know starting in 2026 that the federal exemption will increase to $15 million. So federal estate tax is a tax that would be assessed when you die. It is a tax on your right to transfer assets at death. Gift tax is on your right to transfer assets while you're living. And usually, like we talked about, you can use the annual exclusion amount, you can look at the lifetime exemption and figure out the best way to do that. And then lastly, there's state taxes, which for us here in Pennsylvania is Pennsylvania inheritance tax. So Pennsylvania does have an inheritance tax, so we want to make sure that we're thinking through that. Now, I wanted to revisit the family business inheritance tax exemption. So in Pennsylvania, if you die and you own a business and you meet certain criteria, then that business interest is not subject to Pennsylvania inheritance tax, but there are some requirements for it. So the first thing is that it has to be transferred to somebody who is a qualified transferee or a trust for somebody who qualifies for the qualified transferee. So that would be a family member. There's a whole list of people you can transfer to, kids, grandkids, that type of thing. Secondly, you want to make sure you're a qualified family-owned business. So that's defined as fewer than 50 full-time employees, a net book value. Now notice I said book value, not appraised value. A net book value of less than $5 million. It has to have been in existence for at least 5 years prior to your death. And then the purpose can't be for the management of investments or income producing property. So it actually basically needs to be an active business. Now there is a certification requirement, and that is every January for a period of 7 years after the decedent's death, you have to make sure to file a certification, and that certification is due by February 15th each year for the 7 years following. So if you meet those criteria, you can get an exemption from for Pennsylvania inheritance tax purposes. For federal, state, and federal gift, as long as you're below the exemption, 13.9, or in 2026, 15 million, you don't have to worry about that. So planning strategies would be lifetime gifting to reduce the taxable estate, valuation discounts for family held entities. So that just means that if you're going to be gradually gifting it to family members and the new owners are a minority, meaning they aren't a majority owner, you're only gifting them, for example, 10%. And there are transfer restrictions, meaning that the operating agreement might say that if they want to sell it, they first have to offer it to the other owners. Then that would be enough of a restriction where you could take a discount on the value, which would allow you to transfer more or a larger percent, but it's actually valued at less for the federal gift and federal estate tax. We call that a minority discount or a lack of marketability discount. Typically the IRS around 30%. Some people go a little higher, some people go a little lower, but it does allow you that discounting value, which would allow you to leverage more or a larger ownership interest if you're transferring it and it's not through a sale, you want to gift it. So that's where those valuation discounts come into play. Now, capital gains and income tax. Capital gains would be triggered upon the sale or transfer of ownership interests. Income tax would be ongoing implications for buyouts structured as compensation versus a purchase. So again, it all depends on how you structure it. An installment sale does spread out the tax burden over a period of years if you would choose to do that. Downside of an installment sale would be it always means the buyer could default on the provisions and you aren't getting your money up front. So you want to make sure if you're going to do an installment sale that you trust the person who you're entering the contract with. And corporate versus pass-through entities, an S Corp versus a C Corp versus an LLC can affect the taxation. In part one, we talked about how an S Corp and LLC have pass-through taxation. Corporation has the double tax. So you just want to think through what entity do you have as it relates to the capital gains and income tax. Now for estate planning tools to help minimize the tax, you can use trusts. So revocable or irrevocable, depending on what you're trying to do. A family limited partnership or an LLC. So if you're a sole proprietor and you're thinking of bringing on kids, if you shift it to an LLC or a partnership, it would allow you to start transferring ownership interests in small percentages to that next generation. Life insurance can cover estate tax or fund a buy-sell agreement. Charitable contributions, you can potentially offset any tax liabilities if you have a charitable contribution. And you always want to make sure that you're talking with your tax preparer, your CPA, tax attorney, financial advisor, estate planning attorney, so that you have an overall comprehensive plan that helps minimize the taxes. Common mistakes with business succession planning. Number one is procrastination. People just don't do it. And then the crisis happens and then they're scrambling. That would be the first mistake and the most common one that I see. Another mistake would be unclear roles and responsibilities for those successor owners. Who's actually in control? What powers do they have? What are the duties that you want them to fulfill? Those would be things you want to make sure you're clarifying. Inaccurate valuations, so either overvaluing or undervaluing the business, can make negotiations very difficult. Failure to fund the plan, so maybe there's insufficient liquidity to be able to complete the transfers. Another one would be ignoring family dynamics, so there might be, if you just say, oh, they're going to be fine, we don't need to worry about it, there's no clear process to resolve the disputes, so you want to make sure you're addressing that. And then lastly, lack of communication. Not sharing information with employees, families, or partners, that would be problematic because if the goal is to try to help this entity transition and still be a thriving business, you have to be able to communicate, especially with your other partners or other co-owners. All right, let's do some commonly asked questions. When should I start my estate planning? I think we've already talked about this a little bit. There's no hard and fast rule. So when I say begin planning at least 5 to 10 years before you transition or you anticipate the transition, that could be more or less time than you need. I'm just trying to give you a ballpark because this would allow you to set up funding mechanisms to identify the successors, to resolve any tax or ownership structuring issues that you might have. It would allow for an unforeseen crisis. So again, you want to cover death, disability, if they would retire. If for whatever reason they're terminated, you want to make sure you've covered those unexpected events. And you have to know it is a continuous process. So succession planning isn't a one and done type of thing. Number one, the law changes all the time. So you might need to be doing some updates because of that. Your life may be changing. Different events might trigger different discussions. So you want to make sure that you're touching base and revisiting your plan on a regular basis if you need to. And I always tell clients once a year is great. You're already going to be meeting with your accountant to go over tax returns. So that's a great time to do it. But again, you can do it as often as you feel is necessary or if there is an event that you need to address. How do you choose the right valuation method? There's no right or wrong here. It has to make sense for both parties. You can do an income approach where you're looking at earnings, cash flow, the present value, the profit generating, all of that. You can You can look at the market approach, which is comparing your business to similar companies that might have sold recently. So that you just need to make sure you have the reliable data to be able to use there. Or you could do an asset-based approach. So that would just look at the assets that the business has and value them that way. So it kind of depends on the business that you are. If you're a farm, it might be that it's the land and the equipment. But if you're not a farm and you actually are operating, have an inventory, then that you want to think through what does that look like. Select the best approach. So you want to make sure you're thinking through your business. Is it service-based? Is it asset-heavy? Is it technology-driven? What would be motivating the valuation? And then you might want to do a professional valuation. So you can get an appraiser, a CPA might be able to do it. You might do a combination of both, but just making sure that it's okay with both parties. All right, our next question is, what if my family members don't want my business? And I've seen it, where the next generation is not involved, doesn't have any interest in it. You might want to consider outside buyers. You might want to consider management buyouts. That's where you've identified like a key employee or somebody who's really invested a lot of time. They might be wanting to buy it. You might want to consider professional management. So if the family still wants to benefit from it and get the profits, but maybe you need to hire somebody to come in and manage it day to day. And then you want to make sure you're coordinating with your estate plan. So especially if your family members don't want to be a part of the business, you want to make sure that you're putting clear buyout provisions, all of that in there. Okay. Can you change your plan once it's in place? Yes. And frankly, if you're going to set up a plan that you can't change, then I'm not sure that's the best plan. You need a plan that can be adapted and changed based on what might be happening in your life. So divorce, health changes, all of that. But then also depending on what the law does, because the law can change too. So you want to make sure it's a flexible plan and that you're not locked in. Document amendments. So typically a buy-sell will outline how do we change or amend the document. If you use trust or other estate planning tools, it's what does that document say about how to make changes? How do you make amendments to it? Timing and notification. So anytime you revise your plan, you want to make sure you're talking with the other stakeholders. You want to make sure you're talking with your accountant, your attorney, all of those important support personnel that you have around you. You want to make sure you're consulting with them. Can you just give the child the business? That's always a question that we have. And the answer is yes, you can. You can just give it to your kids. You want to think through the gift tax implications, the valuation requirements, and then you want to think about carryover basis and capital gains. So if you would gift it, is the gift over the exemption amount? And if you gift it, most of the time the next generation is going to get carryover basis, which may mean that they don't have as much depreciation they can take. They have a different basis than if they had waited and received it at death. So gift tax exposure, still the same question. Why can't I just give my child my business? The IRS does consider a transfer of business ownership for no or less than market value. That is considered a gift. And the annual exclusion amount for 2025 is $19,000. So if you are married and have a spouse, each individual can give $19,000 in 2025. Now, in theory, you'd be able to turn around and gift $19,000 in 2026 too. Usually, the business interest would be worth more than the annual exclusion unless you're going to be giving gradual or percentages. And then if the percentage is equal to the 19,000, then you don't need to worry about it. Now, even if you're over the 19,000, still no tax. It just means that you're using up some of your lifetime gift exemption, which in 2025 is 13.99 million. It will increase to 15 million in 2026. Valuation requirements. The IRS does require a fair market value assessment to determine the taxable amount of the gift. Professional valuation is often necessary to determine that. And understanding the value could attract penalties and prevent transfers until a proper valuation is done. That's really important. You want to make sure you're getting that accurate valuation. This is the basis concept. When you gift an asset, and that includes business interest, your tax basis carries over to the recipient. If your child later sells the business, they may have a larger capital gains tax on the difference between the original basis and the sale price. So that's why sometimes gifting isn't always the best way to do it. But you can do that gradual sale. You can do part gift, part sale. There's a lot of different options. What I wanted to get across, and we tried to do it in a shorter way, that's why we broke it up into two, was just getting across that there are options that you can take advantage of. And there's no right or wrong. There's no cookie cutter approach. It's what makes the most sense for your family and your entity. So when we're talking in this presentation, we're just giving you general ideas. You really need to consult with your attorney and your accountant to really work through the specifics to make sure that it's in your best interest. So you can always reach our office at 717-655-2676. We'd be happy to schedule a time to chat. We always ask people to bring their business documents to the extent you have them. If you have operating agreement, bylaws, partnership agreement, and then any of the formation documents so we can review them as well. And then what we typically do is we review what you have. We might suggest any changes. We might talk about the transition, the buy, sell, or other documents that you need. So, and we are located at 20 East 6th Street, Suite 206 in Waynesboro. And this is Samantha with the law offices of Samantha Wolfe. I really appreciate you guys watching part 2 of our business succession planning. Thank you so much for being here. We look forward to seeing you next time. Thank you.